welcome to day one of Boston Fintech Week. We're really happy that you can be here with us today. This is going to be an amazing lineup, an amazing new space here at the DCU. My name is Jean Donnelly. I'm one of the organizers of Fintech Week. We've got over 40 events this week, and we've got a great and amazing group of folks a part of it. We want to thank our sponsors who have made this happen. We hope that you guys can fasten your seatbelts, get ready for a deep dive on the DNA of Fintech. I'm going to turn it over to Vestigo, who's the head of the DCU.
Thank you very much, Jean. You guys all hear me? Everyone good in the back? Okay, excellent. So welcome to the DCU Fintech Innovation Center. I'm particularly excited to welcome you as you are the inaugural folks at our first public event. So we officially moved in from a working perspective here on Thursday and got the signage up a couple of hours ago. So thank you. So we, as you can tell, are run like a fintech startup as well. It helps us associate and relate to the fintech startups that we support at the center. So we take about 10 companies every 6 months into our nonprofit free program. And we also try and work with partner organizations like the Voting Group and Jim, who are fantastic. And so we love the opportunity to be able to host you guys today and to reciprocate some of that help that you give us. And we're running about 4 or 5 events out of the center this week with co-organizers or ourselves, and have the lounge next door, which you are all welcome to use throughout the week from 8:30 to 5:30. Just come on in, grab some coffee, check out some sponsors, socialize with one another, and have a good time fulfilling in the spirit of this FinTech Week. So thank you very much, and here it is for Jim.
All right, well, welcome everybody. Thanks for being here. We are incredibly excited to be part of FinTech Week in Boston 2.0. Thanks again to Vasilios for always being a great supporter, great partner, allowing us to break into new space. He was only partially joking earlier. Some of the paint is still wet. So, be careful near the walls. I don't think it's hyperbole to say that this event this week doesn't happen without the FinTech Sandbox. So huge congrats to them for pulling off what's going to be a great week. Thank you for including us. So to Jean, to Tatiana, to a lesser extent Mike. You guys are great. Few other quick shout outs to people who helped me in a lot of ways recently and over the last couple of years. Everywhere from recruiting this A team here to bouncing back and forth the ideas and the questions and so on, and just welcoming me into the FinTech community. I'd like to, some are here, some are not. I'd like to quickly say thanks to Jack Klink, to Ian Sheridan, to Dave Balter, to Mike Toriano, to Jonathan Hakim, to Charlie Hipwood, to Matt Rhodes-Croft. And lastly, but certainly not least, if Ron Suber is the godfather of FinTech, then Sarah Biller is the godmother of FinTech. So thank you to Sarah for all that you do. So we'll get this started. Couple quick disclaimers. The food is late. You guys have realized that. We will have that ready for the end of the session, so we'll break a bit early. We'll go for 30 minutes or so, and then we would love to open it up and have you engage with the panelists here. So we'll probably say 5 to 10 at the end, so start to think of questions and be ready to fire away. So maybe for starters, what we can do is we can start with you down at the end, Mark. We'll just do quick intros down the row here. Quick thumbnail on you and tell us what you're doing now.
Sure. So I'm Mark Casady, the general partner of Vestigo Ventures, and we're an early stage FinTech fund based over in Cambridge. So it's wonderful to have FinTech Week, and thank you to everyone who's sponsored such great events. We have a couple going on later this week as well. We're about $60 million in total assets to invest in startups. We'll have about 20 to 22 companies in the portfolio. We have 10 today. I often say I'm a recovering public company CEO and chairman, and I will tell you it's a lot more fun to be investing money in startups and to really get to know some amazing founders as part of that process. So a lot of fun.
everybody, my name is Jeff Glass. I am a serial entrepreneur turned investor turned back to entrepreneur. So I wasn't smart enough to stay on your side of the aisle. Went back to starting up another company. I'm one of our co-founders of a company called Hometap. And Hometap's mission is to make homeownership less stressful and more accessible by investing alongside homeowners, giving them a sum of capital today in exchange for taking a percentage of the sale price of their home in the future. So we are an alternative to debt. Our goal is to help tens of millions of American homeowners that find themselves over-levered, over-concentrated, and in a situation where they are house-rich and cash-poor. And our goal is to give them the capital that allows them to have both a home and a life. And when successful at scale, we not only are helping homeowners with a very large opportunity on the financial side, but we seek to create a asset class giving investors exposure to residential real estate. Jennifer, you have a mic. Here's yours.
Hi everyone, I'm Jennifer Lung. I'm one of the co-founders of a company called Forge.AI. Just a question for you, how many of you here work for a public financial services company? Okay, a bunch. So the problem that we're focusing on is, think about the Fortune 500. Almost every one of those companies today has unlimited access to computing power. The problem that we're tackling is that the majority of the world's information today is not immediately useful for people or intelligent machines. So we've built a platform, we've developed technology that's capable of instantly transforming unstructured data into machine-readable content so that companies can make better, faster, more decisions.
I don't have a mic. Richard Tibbetts. I'm today I'm a product manager for AI at Tableau Software, where we help people see and understand their data. My background's in data management. I previously started a company called Streambase. It was a real-time analytic platform. Most of our customers were in high-frequency trading, capital markets in general. And then more recently was running a company called Empirical Systems that was an AI for automating the analysis of structured data. Tableau acquired Empirical in June, and most of Empirical's customers were also in the financial services space, though it was not a financial specific product.
Awesome. And I'm Jim Urquhart. I am with the Bowdoin Group. Bowdoin Group is a Boston-based executive search firm dedicated to the innovation economy. I lead our fintech practice and help early and growth stage companies in the financial services technology space find their most critical people from C-suite down to building out teams. So I guess as a starting point, we'll start with you, Richard, and work this way. So everyone on this panel has done something new in the last year or two. It's, founding a new company, advising a new company, investing in a new company, starting a new fund. So with that in mind, take us through a little bit of that thought process leading to launching the new venture, and then tack on to the end, why now?
Yeah, no, that's great. Well, so I suppose if we're limited to things within the last year, I sold my company within the last year, as opposed to starting it. But really, the why now? What were we doing? We had an explainable AI for automating the analysis of data. But what we were finding was people really wanted that to be part of a larger ecosystem of data investigation, data exploration, and our mission was really to help people make better decisions, which meant being able to reach more people was very desirable. So one of the things that I'm seeing is a sort of mainstreaming of more advanced analytic capabilities, and Tableau became a really great vehicle for us to do that. So rather than trying to compete in the business analytics space, we're really able to slot into an organization that already has enormously devoted customers and plenty of cash, as well as 70,000, 80,000 different organizations that they're working with. And so the opportunity now for me, as I see it, is that everybody's expecting better analysis from their systems. And they're not just expecting that in their sort of emerging technology group in one corner of the bank. They're actually expecting that everywhere.
So, 12 years ago, I worked for Mr. Glass here, as did one of my co-founders, Jim Crowley. And the name of that business was MQ. MQ was acquired midway through 2006. So post-transaction, Jim, our third co-founder, Jack, and I got together. We were really fascinated with the work that Jack was doing. Jack's our CTO, he's our technical co-founder. And what he's spent the past 20 years doing is building very complex systems for the national security space. So us knew that there was a massive commercial opportunity to bring this type of technology to market outside of the government sector. But we needed to wait for the market to mature. We needed to wait for companies like yours to be able to really harness machine learning advanced analytics. We need to be able to build this platform not on supercomputers, which require millions and millions of dollars to build, which VCs would not fund. But the market has now reached a point where, in financial services specifically, each one of these companies have very mature processes around data evaluation, sourcing, integration. There are very sizable budgets available, and most importantly, you all have systems that are capable of consuming our very rich stream of data, and that's why we've taken approach.
What is this one? So, even though Jen talks about a company that we sold 12 years ago and started 18 years ago, I'm only 30, so I don't know how that was possible.
It's one of the world's biggest mysteries.
But actually, it does kind of play a role in how or why we started at Hometap. So this isn't the first company that I've been involved in, and I think on a personal level, you know, I think I've become increasingly aware of, more so than when I was younger, of the world around me and the chaos that we live in and the difficulties of life, and was determined that if I was going to start another company, to try to start something that really had a major mission and impact on people and homes and lives. And the personal story behind this is that if you go back about 2 years ago, by pure kind of divine intervention, two things happened concurrently, which was, one is I was helping a young entrepreneur who was working on a startup in Boston, and he was talking to me about the fact that neither he nor any of his friends, even though they've all gone to good schools and have good jobs and have steady income, none of them were able to even contemplate or even begin to contemplate the ability to purchase their first condo or apartment or home. And that they had the ability to pay a mortgage, but they just didn't have the capital to be able to put down. And that was kind of the first light bulb that went on for me. And the second, which was, again, pure coincidence, but someone more of my contemporary, so age 30, was talking about, they lived in Newton. They were a dual income family for a while. The husband was home taking care of kids. The wife was the major breadwinner. She lost her job. And it set off, they'd been in Newton for 12 or 14 years and built up a significant amount of equity, as anybody from Boston knows. If you've owned a house in Newton over the last 15 years, it's worth a lot more than what you paid for it. But despite that, it set off a whole financial tailspin for them. And they wound up they weren't able to refinance because they didn't have any income, so they couldn't borrow, even though there was all this equity value in the house. And they wound up having to move, and it messed up their kids' lives. And so these two things happened concurrently, and I was, with some others, was in the process of thinking about new business ideas, and that was the beginning of how we started to contemplate today this business called Hometap.
I will proudly say that I'm 58, and I've spent 36 years in financial services. I've never seen an opportunity like the one I see now. And I've been in a lot of amazing companies and had a lot of amazing things happen. But in the end, we are in the digital age for financial services. Many of you are starting companies or in companies that are really thinking that through. What shocked the heck out of me, related to Boston and Cambridge specifically, was there was not an early stage venture fund focused on fintech here. It seemed to be a massive hole in the marketplace. And so Dave London, who's the other general partner, and I decided to set up Vestigo now about 2 years ago. I've known Ian Sheridan as long as I've known Dave, and Ian joined us quickly, and then Mike and Fraser, to really look at that. So I've never seen an opportunity so available to us in terms of early stage fintech, both to help to get the flywheel going, right? Events like these, organizations like DCU's organization here, or the Fintech Sandbox, of course, the incumbents that you can throw a rocket hit in this town, and the universities that do a fantastic job of getting students excited, and then they can't go get venture funding along the way. So we see a huge opportunity in this space, if you will, almost literally. Secondly, we see disruption about to occur on a scale that financial services doesn't quite understand. It is going to be a very different type of disruption than was seen when other industries went digital. And the third issue is actually similar to yours, which is access. I've spent my entire career mainly coaching very wealthy families on how to keep their wealth and get wealthier. Fun, they have really interesting problems, but at the end of the day, what's a lot more fun, and what I enjoyed at LPL Financial, was we served a group of clients who would not get service had we not had an agent somewhere in Columbus, Indiana, or Martinsville, Indiana, where I grew up, to be able to help them. And so the other piece that I see here is a chance to bring down pricing and to really change the customer experience and create an industry that's much more inclusive than the industry that I've been part of for a long time. So for me, it's those motivations that led us to put capital up and get going.
That's awesome. So sticking with you, Mark, I want to get your opinion on a thought. So I think the rest of your fellow panelists here, I think, are have in common that they've done other things, right? It's not a bunch of people who've come out of a bank or a fund and so on, and they've had successes in other types of businesses, other industries, and so on. As you evaluate companies and as you look at the market from Vestigo's perspective, are you seeing that at all in terms of successful tech entrepreneurs who are intentionally or unintentionally getting into financial services, or it could be first-time entrepreneurs who don't have a background in finance but see a problem to solve and see technology that they can build?
It's a little bit of both, and we're welcoming them all, right? So one way to think about it is financial services problems do require a little gray hair, right, to be able to understand them and to be able to live them and to be able to bring a solution to them. So it's sometimes nice to take someone who's from an organization, an insurance company, or an asset manager, and they're leading the charge along with folks who maybe have a bit more entrepreneurial experience, taking on some new challenge in the marketplace. The other areas for serial entrepreneurs, the kind of backgrounds that you guys have are incredibly impressive, and you're going to be successful. The question is, how successful will that be? That's an easier bet to make as a VC because it's been proven that that team knows how to win and has won before. The company has all sorts of variables to it, but having the team matters a great deal. So we see a little bit of everything as it relates to it. It's wonderful to have failure. I can give you 100 examples of failure in my career in 36 years. And what's wonderful is to really experience that failure with others, meaning that there's something you learn from it and made you stronger and made you understand how to be perhaps more flexible or to think about the world differently. So when we're talking to teams, we're really trying to suss out what's the dynamic of that team, what's the culture the company's trying to create around that team, and is that team strong enough, in their opinion, to be headed forward, but not so strong that if they run into a wall, they won't pivot, right? That for us is kind of an ideal state, no matter what their backgrounds are. And then we'd love to see a team that's mixed in terms of entrepreneurial experience, as well as some incumbent organization issues.
You guys want to build on that, just in terms of that, like maybe respectively with your individual companies, how do you, starting from the founding team, how do you think about that? What constitutes a great founding team, and then how do you, play against one another? Mark's point about the industry knowledge, along with just startup track record, and that being in your DNA, and knowing that they can do the job here at this company that's moving really quickly and has a lot of variables. Go ahead, Dan.
All right, so, well, our team came together, our founding team, 3 of us, because Jim and I worked together in the past, and so there was great trust and respect there. Jim and Jack had worked together prior to that and took a company public on NASDAQ, so the 3 of us were able to hit the ground running. Our core team today, most of us have worked together before. One of our most senior architects, it's our 6th company together. So I would say the advantage of sort of getting the band back together is that you can just shortcut a lot of the processes typically involved in learning how to communicate, learning how to work together, just being able to trust people that we know our jobs, we're going to divide and conquer, get it done. So that I think helped us accelerate. I would say where we need to really prioritize our team building now is in injecting formal financial services, fintech DNA into our team to make us stronger, to make us better, especially as we prepare for a very aggressive go-to-market moving into next year. So what we're very focused on now is just surrounding ourselves with as many domain experts as possible who can help us get smarter and do a good job of attacking the market.
Yeah, that's a great point. Having the pre-existing relationships is very valuable. I also think as you're putting together a founding team, you should distinguish between pre-existing work relationships and sort of pre-existing social or interpersonal relationships. because they both can feel like very strong relationships, but there's actually a lot of investment to be done in building that working relationship with somebody you haven't worked with before, or you've just had a long sort of social history with, or roommates, or whatever that sort of relationship is. Both are good. And then I would echo the need to identify what are the core capabilities that are going to make your company better and different. And if the core capabilities are around technology or around go-to-market, what are your points of innovation? And if your points of innovation are really deep knowledge of some corner of the fintech space, then you really do need people on the founding team that are completely committed, who have that depth of knowledge. But my experience actually has been in building companies that were general purpose technologies that we initially commercialized in financial domains. And in that case, you definitely can bring on board the talent. And the other bit of advice I'd have there is just be cautious as you're hiring in that notion of expertise, because you may not know how to evaluate expertise. So if I look at my experience in Streambase, like there were layers of expertise that we built over time. And at one point, one of my senior engineers got poached by Goldman Sachs. I talked to her maybe 3 months later, and she's like, "You don't know what you don't know." Wow, I learned a lot in the first 3 months at Goldman. And so that process of like building up that collection of expertise within the organization, if you're starting from nothing, you should expect to take a couple of steps. So don't be afraid to bring people in as consultants, or bring people in temporary ways, or to work with people who won't join your firm, but they're willing to advise you in finding the right people. All those are ways to bring in that expertise.
I'll keep it brief. I would just say, in addition to what's been said, is to remember in a startup, if you're going after something difficult, it probably requires some level of blissful ignorance. And when I think about several of the companies that I've been involved with at an early stage, if I knew what it was going to take to actually make them successful, I'm not sure I would have started them. So I think you do need the combination of industry domain expertise, but also a little bit of, I don't know what I'm getting into, is probably not bad.
So I want to build up something that you said, Jennifer. You're reaching a point where you need to inject more formal kind of fintech, financial services. So talk to us a little bit about like what juncture are you at? Like when does that come into play? Do you think about that more functionally, meaning that certain types of people should have more domain? And then I guess add to it, you obviously have an incredible amount of trust with that core team that you've worked with before. How do you maintain that with new people who have not worked with you before and maybe don't have the same level of kind of trust that you've developed over years with people in the past?
So the stage that we're shifting into in the next stage of our company's growth is okay. So to date, what we've done is primarily between the co-founders, we've conducted very intensive customer development with our prospective customers. So we've tried to meet with each of the largest financial institutions globally, and through that, those conversations weren't selling conversations. The goal wasn't to leave the meeting with a signed contract or an agreement. The main goal of those meetings is to really learn about the pain points, validate that the solution that we think could be valuable to these partners indeed is, and where not, where we weren't hitting the sweet spot, to be able to learn from these discussions and adjust our product planning accordingly. So I would say we spent a fair amount of time doing that. We also have done that with advisors and very smart people like Sarah. But we now have reached a place where we think we've, through these conversations and through our own thinking and designing, have been able to define a few very concrete use cases that we can take to market repeatably across multiple customers. Version 1 of the platform is up and running. There are very large companies that are consuming data from us today. So the bulk of the financial DNA that we're looking to add to the team now, which the team will help us with, is building the go-to-market team, right? So our head of sales should probably have very deep Rolodex and very strong relationships on Wall Street, and probably is not someone who's sitting in Cambridge who, can't walk out the door and be in the office of Goldman Sachs in half an hour. And the people who work with them should have that same sort of skill set, the relationships, the understanding of, it can be even as simple as the right terminology, the right words to use. Stuff that isn't necessarily natural, obvious to us. We're confident that we can build a technology that put the right tools and materials in the hands of a go-to-market team, but we really need the experts who can go in, talk the talk, walk the walk, and make things happen.
I just want to pick up on something Jen said as it relates to this idea of expertise and how much you have inside and outside. Obviously, it's a mixture and there's subtleties around it, but one of the things, as you were talking, Jen, I was thinking about that's interesting is the perils of raising capital and the perils of raising capital too soon or raising capital too much capital, or the perils of how certain venture capitalists, and I was one for 7 years, so I'm not, this isn't any dig at VCs, is the danger of trying to have operational, definable metrics and performance too soon. Because and I'm all, of course, one of our key attributes of our whole culture is around execution, and it's one of our key defining cultural attributes. So this isn't meant to say, obviously you're building a business, you have to execute, but one of the things is, even if you come from, even if you have all the industry expertise in the universe, if you're starting something new and innovative, you're doing something that hasn't been done before. And so there's an awful lot that you have to learn. And so there's a careful, delicate balance between, like I love what you said, you went out and you talked to all these people. We didn't write a line of code for over 12 months on any of our product, as we were out on what we call the listening tour. And we had hundreds of conversations with people across different parts of the ecosystem to try to figure out where the opportunity was and how it all worked. And we were a little lucky. We had we were capitalized with very patient early capital, and so we really were able to kind of go out and learn. But I think that I could see a situation where if you take capital too early, then you're feeling pressure to show something, show performance at your board. Learning isn't really tangible. It's hard to convince your VC board member that you learned something.
Not the right VC.
And so not right here. That's why anybody out here should.
Well, it's why it's the difference between early stage and later stage, right? If you were doing a C round, the if you're doing a C round, right, the issues are quite different. But if you're doing a seed or an A round, which is where we're typically investing, exploration, we would applaud someone who's going to spend time with a prospective client to learn what they can learn and learn what they shouldn't be doing in that goal to get to monetization. And so I completely agree with that premise. I do think that's the difference between early stage and later stage. In later stage, it really is a little bit more operationalized in monetization of a strategy that is working. And therefore, the question is, how big's the market and how fast can you go? So the pressures are different in different places.
And I think you hit a great point, which is for people raising capital, starting businesses, the most important thing, especially early stage capital, but I think all the way across the business, is the alignment that you have with the capital. And that's what we're talking about here. And I think you make a good point.
Yeah, I think that's you do not want to take, let's call it professional capital for lack of a better word, as opposed to taking friends and families capital or others if you're not aligned, right? Because you will automatically have a problem in the boardroom or elsewhere as you go through it. I think the other thing that's important to understand is what is it you're learning from those exercises, right? And what's the goal in the learning that's there? And how does that affect the MVP? How does that affect the way that the team's thinking about it? You want to applaud a team that sees something in the market that's quite different than they thought. We have a company that basically we invested because we love the team and they had an idea it would be as close to a cocktail napkin kind of story as you can get to, and they're in exploration mode. They thought they were going to start in one business. They've added sort of a couple of others. A little nervous about the wondering that's going on, but at the same time, they are very smartly going about understanding those businesses. They're smart enough; they're going to figure it out, right? And the question is, what's the market want? And in their case, they're basically creating for hedge fund content and tools for crypto trading. Boy, talk about a market that's either a completely red minefield or is a blue ocean. I'm not sure which, but a little bit of both along the way. You want them to explore because it's the only way they're going to get there. If they can go a bit faster in the exploration, right, and then build something interesting, they're likely to be successful.
As a show of the community in the Boston Fintech scene, I don't know if you guys noticed that Mark held the microphone for Jeff. Its inclusion.
Just trying to get the A around.
Be very patient.
We're going to be doing a duet at the end of this.
Did you have anything to add to that?
I mean, I would just say that exploration phase is very important. As a founder, as an entrepreneur, you're your own diversified investor. You're putting your time in, you don't get to do more than one at a time. And so as you're doing that learning, that exploration, you should be thinking about, what would we, if we weren't
And do you think, is there merit, and we'll start with you, Mark, is there merit to someone who, you know, the learning tour, the discovery mode that Jeff alluded to, is there merit to that as you think about it as an investor of a team of entrepreneurs who are going to, you know, take that more calculated approach versus someone who kind of comes from the industry and maybe thinks they know all the answers versus someone who's going to really do a lot of deep due diligence and come back with something that's tangible?
Yeah, it's a great question. It's a tough question, right? I find myself, having been an operator in the business for a long time, of literally saying to myself, suspend disbelief, right? Hear the pitch, you know, observe the team's pitch, observe its dynamic, observe what it's thinking about the market, because the cold reality is if you bring certain business plans to me, I have spent 36 years looking at wealth management in a lot of different ways, and I can very quickly get to an answer that isn't necessarily the right answer. And so I do find that I have to stop myself and listen closely to what's there, and then observe it, and then if I'm still unsure, right, you can sort of work with the team that's pitching to say, well, go try this idea. I've got a half dozen companies that have come back. We haven't actually invested in them because the original pitch really didn't work for us. But they, to their credit, went back and pivoted based on some of that feedback, actually found some market traction, and now we're interesting companies. They're really, again, these are all seed stage companies where they've been self-financed for the most part. And that's fun to see, right? That's exactly what you hope they explore. But I do find that having had a lot of experience, you have to be careful about your own bias. You know, we all have bias, we all know that. And the trick is how do I suspend that in this moment, because this is something different, you know, look at and understand. And where is the bias helpful, and that you can short circuit to an answer that might help that company pivot a little differently than they planned. So balancing act with that somewhere. It's also when you think about employees, right, the issue that you have to be careful about is coming from a large organization. Excuse me, I did the entrepreneurial thing back in my 30s, and at the time, the Andreessen Horowitz of its day was Hambrick and Quist on the West Coast. So we had a venture funded, thank you, somebody remembers Hambrick.
I ran their Boston office, God bless you.
But importantly, they were an important venture source, and back in the day, they funded Apple, just to put it for you. We had a company that you know, made them about $40 million, so they were pretty happy off their $1 million investment. So it was a good turn. But even then, I still find myself fairly conventional when I think about financial services in and of itself. And if I came out of a large organization to be entrepreneurial, sounds fun, right? But that means you have zero resources, right? And so part of what we look for in a team is the person who's coming from the incumbent really understand how much they're going to have to contribute to success of the organization, so they get what it really means to be there with you know, much fewer resources than I used to.
That's a perfect segue. It's almost as if we've prepared for this. When you talk about that, in terms of how do you, and we can come back down the line here, but how do you kind of regulate and think about that? There's so much importance around incumbent or industry knowledge, but that may be somewhat at odds with the culture of a startup. We move quickly. It's okay to fail quickly and fail fast. Like, have you had experience, like maybe we'll start with you, Jeff, have you had experiences more recently in kind of managing that bit, the pace of play of a startup against typically slow-moving clients and industries and potential partners?
Well, first of all, I don't think what you're saying are mutually exclusive. So you can come from a large organization and bring domain expertise, and that doesn't mean that you're going to be slow and not dynamic to kind of execute, iterate. And as we all know, the best startups, what they do is they execute relatively rapidly, and then they iterate, and they build themselves to be able to do so. And for sure, if you can execute in a better starting place than not, because you're informed from industry knowledge or a board member who's got experience, or from having done the Jennifer Lum learnings tour to talk to customers and see what they have to say, then you're starting off in a better place. I think all this stuff boils down to everything has a double-edged sword. So if you have a ton of industry expertise, and if you're the type that thinks you know it all, then you're going to be in trouble. Because as soon as you think you know it all, you're done. Of course, if you know nothing and you're just sort of walking around trying to build a solution for Goldman Sachs, they're going to laugh you out of the door. Out of the door. So everything requires kind of balance. I think your team requires balance, and at the end of the day, really what you want to do is you want to go into these things, execute it quickly, listening, not breathing your own words, recognizing the fact you're going to make mistakes, the percentage of, bless you, the percentage of successful businesses who end up in a very different place than where they started, it's almost all of them. There's very few companies that really just start in one place and that's where they finish. So I think that's really the key to being successful.
Anything else to add?
I mean, I guess the way that I think about it is, it's not necessarily big company versus small company person. It's really that mindset, right? And being able to assess whether or not this candidate will be able to succeed and thrive in an early stage environment where undoubtedly it's going to be full of chaos. There are going to be twists and turns on a daily basis. There's going to be highs and lows. And regardless of where they're coming from, are they going to be able to work with the team to get through that day after day after day?
Yeah, I think for the most part, people coming from larger organizations are not slow people, they're just in slow organizations. And the slowness is usually gotten by risk, by the fact that if you screw this up, you've ruined something that's tremendously valuable. And sometimes you have to remind people that if you screw this up, we're only out like $3 million. You would rather they not screw it up, but that they also can't check off every box and can't go through every process to prove that things are going to be perfect. So there's a need to encourage people to take a risk and to acknowledge that. But at least in my limited experience, people coming from larger organizations are often happy to be moving quickly. They just need a little bit of guidance on where you do have to pay attention to things, where you can sort of cut corners.
Right. So,
I was just going to say one other thing. It's tangential but related, which is I think these fintech businesses are complicated. There's a lot of parts. There's a capital markets part oftentimes. There's a consumer part. There's a legal, regulatory. There's security. There's compliance. There's privacy. There's data. There's analytics. Like these are hard businesses, and so to a certain extent, well, not to a certain extent, you need grown-ups. Like you need grown-ups in these businesses, and so you can't confuse sort of the fact that someone's a grown-up with the fact that they're not necessarily going to be nimble and quick-moving. Those two are not mutually exclusive. It's also why I think Boston is a really interesting place. Because of the complexity of these businesses, you need to draw upon a variety of skill sets into your organization. So you need a security expert, you need a privacy expert, you need someone who can handle legal and compliance. You need to have folks who understand capital markets and understand Wall Street. You need to be able to build a great consumer experience and tech products. So because we need all of those pieces, I think there are really very few places where you can build sophisticated fintech businesses that are better than Boston.
So let's broaden that theme. I think that's a great segue as well to a big theme that we're going to hear this week across a number of events, partnerships. Right? So, you talk about, you can use that term broadly, right? Partnering with an incumbent, partnering with an early advisor who comes from an industry. Let's come back down the line and talk about the value of partnerships. And when you think about it as an investor, Mark, is that a big part of your due diligence up front as a partnership strategy? Maybe it depends on the business, and then with the rest we can talk about early experiences and exposure to partnerships.
So our thesis of how disruption occurs within financial services is that we've done in partnership with the incumbent. The incumbents in this industry have incredible value. They have brands, they have trusted brands to the consumer or to other businesses, and they also have incredible amounts of data to play in, and they have incredible amounts of capital, and they have really high margins, right? So it's an insanely profitable business. Name one of the businesses in the world where you can lose market share consistently year in and year out, and your profits actually still go up, right? I mean, it's remarkable. That is true in the asset management business. Jim Smith and I worked for a company that did exactly that for about 7 years, and then we sold it for billions of dollars. It was great. It had been horrible for consumers and horrible as a business premise, right, in of itself. So imagine going up against that as a startup trying to attack essentially the customers of that entity. It's going to be very hard to get a consumer to work directly with an unbranded startup. So we tend to favor B2B businesses. They all help consumers in one form or another. There are some places in which B2C makes lots of sense, and I don't want to discourage anyone from looking at that in and of itself, but it is important to understand that in financial services, there's an awfully big impetus to working with the incumbents that are there. So I think that partnership and the way you behave in that partnership is important. I try to avoid, the cheap R&D play, right, where somebody pays you $100,000 or $400,000 and you think you've made all the money in the world, and what they're really doing is just tapping your brain and paying you a small amount of money for it, as opposed to signing a long-term contract for organizations that are not afraid to fail. I see any number of companies that are here in the Boston area, if not across the U.S., that are happy to do small experiments and fail. They won't risk the core business, right? They shouldn't and they can't, but they're willing to fail on a small scale with a partner. That is a really critical cultural piece of what that organization may be about, which would be the marker I would look for if I were in a startup looking to partner with someone from there. So that openness. And you want to find someone as an advocate, right, who really believes in what you're doing. And they may not, frankly, I wouldn't worry about where they are in the power structure. You've got to find that person who's so much a believer, they could be on your team almost, particularly in really large organizations like insurance companies and things.
Okay. Yeah, so I think partnering is very important. One piece of advice I tend to give is to be very cautious about the structure of those partnerships. So in dealing with a large multinational, you really would prefer your contract structure look like you have sold them some software. That's because that's something they know how to deal with. Whenever people start dealing with collaborative development and joint ownership of IP and all that sort of thing, it's like it can just get so deathly complicated. The only times I've seen those be successful is when they were spinning technology that was developed at the bank out into the marketplace. But if you're coming in from the outside and someone's saying the way we're going to do this is with some sort of joint development effort, I would be very cautious. Well, I would run screaming, and I would encourage you to be very cautious. That's my thoughts on partnerships. That said, find the people who love you and want to be on your team. And there are people I worked with in a large bank who were like, I really want to quit my job and work at your team. And I'm like, yeah, but you're not going to because they pay you a lot. So they want to be on your team. They enjoy their participation. They're going to be your advocate. They're pulling for you. But at the same time, they are your customer, and their employer is definitely your customer, and that's important to remember.
For our business, given where we are right now, there are a few different flavors. So on the demand side of our business, people who will eventually hopefully write us very, very large contracts, we do call them partners. We don't call them customers today, and that's because we are working in this very sort of intimate fashion with them, where they are bringing resources to the table, whether it be data, people, expertise, and they're helping us refine our product, refine our use cases. Ultimately, they're consuming our data and reusing it in various use cases within their walls, but they truly are partners to me. Eventually, we'll get to a place where they'll step back, they'll be a little bit more hands-off, but today they're really helping us build value in the company. On the supply side, it's much more clean-cut, where there are just known data partners, data companies that we'll need to do deals with and bring them to the company. Fintech Sandbox is helping us a lot there and helping us identify the right data partners. But I would say, one piece of advice for early stage startups, I'm not sure if you guys agree, but I think generally it's not the best practice for startups to pursue partnerships for their early stage companies and startups. Not a great use of time. One observation that we have as we're engaging with these large financial services companies is that many of them are developing these tech media groups or emerging tech groups where their job is to identify emerging tech companies and tech vendors, understand their value prop, and help them navigate towards the appropriate business units within their walls. They've been tremendously helpful to us.
Good.
All right, let's open it up to you all. Anybody have some questions you want to throw at these folks?
And for Jen and Richard, how do you think about the Google, Microsoft, Baidu play in fintech? Friend or foe? How do you think about them?
I mostly think of them as competition recruiting engineers, so I'm not quite sure if you're thinking about. So they open source some technology that's sometimes leverageable, but I don't pay super close attention to that. I do find it's sometimes challenging to recruit people out of Google. My go-to is to say, if Google's an advertising company, if you want to make a lot of money in advertising, why don't you just go to Google and make a lot of money in banking? But from my perspective, it's mostly how do you get people out of those firms, and that is, I could fill a whole conversation with that. Beyond that, I don't really think of them very much.
I completely agree with that. And I would say another attribute or factor that we feel pretty strongly about is that if you look at any of the leading internet platforms, their core focus is to bring as much data inside their company as possible. Whereas our focus is to make
that if you're in the B2B sort of fintech space, most of those organizations have no idea how to talk to large enterprises and do business with them, and so they're almost a non-factor.
Other questions?
Yeah, I have a question for Mark. Earlier you mentioned the disruption in the industry, that what's coming up may be something we have never seen before. Can you elaborate a little bit? What do you have in your mind about that?
Yeah, thank you for that question. So the question is what will that disruption look like for financial services? And I think it's two simple things. It's cost and customer delight, right? That those are two things that most financial services companies, including when I ran for a number of years, we tried our best, but it's really hard to accomplish inside of big companies. So what we're seeing is cost pressure. So ETFs, so sort of mutual funds, easy for people in this town to understand. They're a better technology, right? They delight customers in a better way, and they're a lot cheaper. So they're the killer app in investment management. We've seen robo-advisors who've created at least a different conversation about pricing for basic asset allocation. Now, the incumbents adopted those strategies, right? Schwab and Vanguard in particular, and Fidelity as well, have done a really nice job of adopting the strategies and sort of pushing the startups out of the way, which is why they're fierce competitors that are there. But what you're seeing is this really big push for cost, and then consumers, as we all know, we all experience it, right, have learned how to use technology from other providers like Google or of course Amazon and your iPhone and everything else, and when it doesn't happen for you that way, when you go to your bank's app or you go to your insurance company, you're saying to yourself, it doesn't have to be like this. Over here, it works just fine for that to be simple and easy to use. So you can see the incumbents, and I've particularly seen this in the last 2 years where I've spent time with a lot of organizations in the incumbent side, really starting to understand that, and doing some wonderful work to try to adopt those capabilities. And again, doing it in partnership with startups where they know they can't move fast enough to do it. But anything you can do that creates a less expensive outcome, using AI is a fantastic example of it, or a better customer experience, it should be something that the right incumbent definitely wants to do. My hope is the whole industry will go through a margin compression that's a healthy margin compression, right? The financial services industry takes too much of the total take of the U.S. economy, usually in the form of wages. It's nice when you work there, right? But when you think about it, it actually is removing too much of the value, extracting too much value for itself, rather than giving it to the consumer who's providing those assets or buying that house or whatever they're doing along the way. That's what's got to change. It's going to change because all the tools that are available to us today are really just now available, right? The massive amounts of data. AI is a really usable technology that is relatively straightforward than it was 5 years ago. And this cost pressure that's real from consumers, and it's going to get even more pronounced as markets normalize. We've not been in a normal stock market for the last 10 years, but if that starts to normalize, which it will in the next few, consumers will even be put more pressure on the incumbents that are there. So don't want to overkill the question, but it's one that I spent a fair amount of time thinking about.
Probably take one more if there's anybody.
Brian Crowder, Dutch Execution. A lot of the definitive line through this has been trust, right? I think a lot of that has to do with the complexities you mentioned with fintech. And just in general, that collaboration across the team. One of the things that Jim said just now that I thought was interesting, and I wanted to clarify a bit, was to sort of stay out of partnerships early, right? And it makes a lot of sense. My question was, at what point, let's say you have founding team members that are income industry experts, so people that did jump and are moving up now quickly because for whatever reason they made that decision. Does that change sort of the viewpoint on partnerships?
Yeah, I just want to clarify. What I meant was, I believe that it is a good use of time for early stage startups to try to pursue partnerships with other early stage startups. Absolutely, go after the whales.
Okay.
Do
I thought it was
everything
sort of
now.
an incumbent thing.
But if I walked into Jeff's office and met with him and his team, he's got a lot of other important things to try to figure out right now than to do a small deal that he partnership with my company that may not pan out. There's not an obvious concrete opportunity for us to go after together at scale.
All right, well, why don't we wrap up with some parting thoughts then, starting with you, Richard. Why don't you, if you want to just quick, how do you think Boston FinTech is identified, should be identified, and what are you most excited about moving forward?
Yeah, it's a great question. I mean, in terms of what I'm excited about in the Boston area in general, it's an affinity for not feeling required to disrupt the incumbents. You know, nobody wants to Uber, Mass General Hospital or Uber Fidelity. And that's good because you're gonna bloody your nose on those castle walls a great deal. So there's a willingness within the Boston ecosystem to actually admit that the incumbents have value, they're creating value, they have brands, and they don't just need to get thrown out of your ear because they're all fools. And so that being said, it leads to the ability to build organizations that build software for others, that build software that can get leveraged, where rather than building systems that do one thing, you're actually in this sort of more traditional B2B environment where you're developing software, selling it to other people, leveraging the implementation, learning from your customers, and creating what I find to be much more interesting organizations that can be learning from many different sources, learning across many different things, rather than feeling the need to reinvent the wheel. And so, Boston, if I was going to sort of think about one thing, is we have a great deal of respect for expertise. And even among the 23-year-olds who just came out of school, there's like an assumption that you can learn from people who've done it before. And so we don't need to do everything completely de novo. And I think that can allow us to build, stronger, higher impact things, though it's obviously, cuts both ways.
Awesome. Anyone else want to build on that?
Well, what I'm really encouraged about with this event and the Boston Fintech Week in particular is that, look at how many people have showed up on a Monday to talk about Boston Fintech. That's pretty encouraging. And I think Boston's community, entrepreneurial community, is known as being quite collaborative. I'm really excited about the fact that there are large market-leading incumbents here and no shortage of technical talent and scientists. So if we can figure out how to continue fostering and growing collaboration between the two, it's going to lead to really great things. Selfishly, I'm so happy about the fact that this is the first startup event part where I don't need to be hopping on a plane or train to get somewhere else to have enough customer conversations to get a company off the ground. And so that's awesome.
So this is what it's like to start a company in California.
Yeah. Right.
Yeah, I just would say where I started. Look, there's three things that are so important in our lives: our family, our financial lives, and our health. And those things come together. And I just think that it's super neat that we've got momentum here in Boston around the fintech space, where we're building businesses that have major impact in people's lives. And I'm just thankful for you guys putting this together. And this is the beginning of a lot of conversations.
The only thing I'd add is bringing in the universities, and we talked about it a little bit before, is that they do some amazing programming for the students, and there's lots of ways to get involved from there. So lots of ways to get involved, and that side of it as well. They're doing a number of the events this week, but it's so fun to watch an event where you've got students, say at Sloan or something, bringing their ideas forward, having people who are from the incumbent part of the industry, having VCs there, of course, we like, and having other entrepreneurs there who can inspire them. So that's really powerful. It's as powerful as these gatherings are for folks who are a little further along in their careers or their company ideas. So it's the more we can do to encourage that gathering, the better off we'll be. But it's a huge opportunity in the greater New England area. It's just really quite incredible that it hasn't had the spark. It really started by Fintech Sandbox a number of years ago. So it's great to be at this point, and a lot more to come.
And I'll just add that, so last year, the first Boston Fintech Week, I think it was planned out 48 hours or so beforehand. It was 12 events, 12 or 15, and everyone thought it was awesome, truly. This year it's more like 45 events. I'm not a math guy, but that sounds like the numbers are growing.
Definitely bigger.
So I'm excited about that. So let me say thank you to our panelists for taking time out of your day. We really appreciate it. Let's have a round for these guys.